Thank you for joining us today. My name is Daniel Gilham, Managing Director here at Farther. My area of focus is really around the advanced markets, um, which is the more complex opportunities that we get to serve, and that is a big area of focus around business owners and entrepreneurs for our team. So here at Farther, we're an intelligent wealth management firm that pairs technology with expert advice, really to ensure that our advisors have the ability to give a comprehensive offering in the most objective, unbiased way. Really excited to be here with two of my favorite people. Taylor Nissi, Managing Partner at Pleasant Street Advisors. Taylor is a certified financial advisor, a certified exit planning advisor, and has built a phenomenal practice focused on entrepreneurs and business owners and providing them that comprehensive advice. And then Dr. Jason Cherubini, a movie producer, a professor of finance, business consultant, who is a certified public accountant, certified management accountant, and a chartered global management accountant. So, kind of to set the stage for this conversation today, everybody's been talking about the one big, beautiful bill. And what does this impact mean to business owners? What does it mean to families? And given the expertise that we have here today, we're just going to talk specifically around business owners and what should business owners and entrepreneurs be thinking about when it comes to this new act. So, to give some context, there are 9 million baby boomers that are going to be selling their business over the next decade. 82% of these business owners say that their business is their largest asset, yet only 19% of them have engaged with a team like this around comprehensive planning that includes that highly concentrated and illiquid asset, which is their business. When we talk to business owners every single day, taxes usually come up as one of the top 2 or 3 concerns when we're diving into what's on the minds of business owners. So for the next few minutes, we're going to talk about the One Big Beautiful Bill Act and how that impacts the business owners that we are conversing with. So Taylor and Jason, I thought, there's a lot in this act, right? And there's a lot to digest, many different applications for business owners and families. So maybe it's best that we just start at the income tax updates. Taylor, what do you see when we think about income tax and the tax brackets that are set out in this new bill?
Hey, Daniel. Hey, Jason. Thanks so much for having me here today. Yeah, I think coming into this year, right, one of the big things people were talking about was the sunsetting of the TCJA, which has been the tax law since 2018. So one of the initial takeaways that I think is getting overlooked because there's so much other exciting stuff happening in this bill is that now the TCJA tax brackets are set, they're in place and permanent for the foreseeable future. So obviously it's tax law, so it's permanent until another administration comes in and changes it. But for our planning purposes, this is pretty significant. If you're a business owner making $800,000 a year, the fact that we're not sunsetting means you're over the next 10 years, you're potentially saving $160,000 in taxes. So that's pretty significant savings for business owners, entrepreneurs, and founders. But, more importantly, it gives us clarity about what's ahead.
And Jason, anything to add there?
Well, I think that's the income tax is one major component, but especially for business owners, some of the other adjustments, whether it's the QBI or some of the capital gains changes, are also worth considering as part of the overall structure, because so many business owners are not making all of their money just from a W-2. It's all of those pass-through benefits as well.
Yeah, and that's a great point. I think it brings up another change within this act, which is the pass-through entity tax elections. Wow, that's a mouthful. So otherwise known as the PTET. Taylor, what are your interpretations of the new bill and what these pass-through entity elections mean for business?
The most up-to-date post-enactment guidance confirms that the deduction for the pass-through entity taxes, or PTET, remains fully available under the law signed on July 4th. And this is really exciting. Well, not exciting, but this is very positive for a lot of the business owners I work with in high tax states like New York and California and other places. Because earlier House and Senate drafts of the One Big Beautiful Bill would have limited or disallowed the PTET deduction, especially for certain specified services, trades, or business, SSTBs as they're called. However, none of those restrictions made it into the final legislation. So this means that partnerships, S corps, LLCs, tax pass-throughs can elect to pay state and local taxes at the entity level and fully deduct them on their federal returns. It's offering an ongoing workaround to the federal SALT cap for their owners. This is particularly advantageous for business owners in those high tax states like New York or California. And the law does not alter this long-standing workaround. So if you're using or considering the PTET, your business can still pay these taxes at the entity level and take the full federal deduction. So this is obviously very positive for a lot of folks in those states.
Yeah, and Jason, as you're consulting and a CFO with your CFO hat on, how does this opportunity for business owners, how does it manifest itself in your conversations, and how do you see business owners leveraging this within their tax reporting, within their financial projections?
Well, as looking at more of a holistic or all-encompassing tax strategy, which is what so many small business or even not so small business owners should do, where they choose to pay taxes, whether it's at the entity level or on their own individual, can alter the cash that ends up in their pocket. And that's going to be a major consideration for so many of these. So as we start looking at where to take your taxes, it's really looking at the end beneficiary on who's going to have those benefits. So are we paying it at the entity level, or are we passing through those tax liabilities? And with things like this SALT tax workaround, which we're still able to use, it gives us a bit of clarity when we're planning and when we're modeling to the future on really what the tax bill is going to end up being, both at the company level and at the individual level.
We've mentioned SALT, the state and local taxes. We've mentioned that a few times. There were some changes to those provisions in the new bill. Taylor, what are your thoughts on these updates?
So the SALT cap was introduced by the TCJA back in 2018, and that basically capped all state and local tax deductions at 10,000. So with the new one big bill, we've seen that exemption expand to $40,000 from now until 2019, and it will increase by 1% per year. However, in 2030, it reverts back to the $10,000 cap. So for taxpayers in high states, whether you're a business owner or just a high income person, this is a nice little reprieve for the next couple of years, but it's not permanent. So again, going back to the PTET strategy, it's a really powerful tool for business owners to be able to create that entity and then use that to get a higher deduction. But overall, this is a nice little break for folks for the next couple of years, and we'll see what happens when this sunsets in 2030.
Yeah. Yeah, I think this is one that most people thought was going away, and I saw a bunch of smiles on Zoom calls and in person when this was included in the final bill. So we also briefly talked about the qualified business income deduction. There were some suggestions that this might go away or be reduced. Jason, you want to chat briefly about the qualified income deduction for these business owners?
Yeah, the big beautiful bill basically put that QBI in at a permanent 20%, and it expanded the phase out bands where it's going to happen. So The phase out band is rising from 75,000 for singles and 150,000 for joint filers, up from a 50 and 100,000. This is allowing more people to get this benefit than had it before. So that QBI allowing you to protect some of your business income from taxes is now available to a lot more businesses, smaller businesses that didn't have it before. And if not paying taxes on 20% of your business income can be a sizable chunk in the business owner's pocket.
Yeah, and I want to hop in here for just a second. I think, tying a couple of these provisions together, the QBI we're talking about right now and the PTET we spoke about a minute ago, really for business owners, the planning conversation here is that this is a really good time to review your entity structure. Both of these rules that we're talking about apply to pass-through entities, so partnerships, S corps, LLCs. And making sure that you've got the correct entity for your business and that you're receiving the income in an optimal way is really paramount. What I mean there is determining how much you want to receive W-2 versus through distributions, because it can have a significant impact on your tax bill. And this really goes into the idea that you want to have proactive tax planning, or at least proactive conversations with your advisors throughout the year, instead of waiting until April 15th and just hoping that things work out well.
Yeah, and the one thing I'd throw on that, Taylor, and I agree with you completely, but with so many of these provisions now either being made permanent or through the 2029, we actually can make good plans today for the next 4 or 5 years. And in that time, and we talk about some of the other areas as well, but also how you're going to structure what the next stage with your business is. So for people who are looking at passing it down to the next generation or are looking to sell it off in that 5 to 10 year period, there may be moves they can make now with the information we have to greatly reduce their tax bill.
Yeah, I think you've both hit on something that we hear all the time, right? It is the proactive versus the reactive advice, especially around taxes. I feel like it's always end of year or right up until time that we need to file our extension or file at the extension that we're racing to come up with some ideas on how do I defer some capital gains? How can I reduce this income? What do I not know about the tax code that I should know in order to reduce that tax liability? And I firmly believe that that proactive tax advice adds a tremendous amount of alpha to generating a larger outcome and a larger return on your entire balance sheet, not just your investable assets. So we spent a lot of time thus far talking about kind of the income tax. Let's talk more about business expenses and investments. One of the other praises that I got a couple of text messages and phone calls about was the continuation of bonus depreciation. Taylor, do you want to talk about that? I know you and I talk a lot about this when we're interacting with business owners.
Yeah, so it's back to 100% bonus depreciation, and it's again permanent. So this means that businesses can now take an immediate 100% deduction on the purchase of qualified property, effective for property placed into service after January 19th, 2025. So it eliminates the previous phase down provisions and it creates that clarity that Jason was talking about. We need to know what's going to happen in the future and the rules of the future. So now we have that clarity. Both new and some additional categories of property as well. So it's the bonus depreciation has really expanded on what qualifies here. It includes certain non-residential real estate. So again, as Jason said, this is a wonderful planning window for business owners who are considering significant investments or capital improvements. And again, it gives us, as the advisory team supporting business owners, the tools and visibility to model out what these big investments could mean, and how that could impact cash flow and after tax returns. So again, a really tremendous tool that business owners, especially business owners who are investing in real estate or have big manufacturing and need big capital improvements, this is a great thing to be talking to your advisors about and see if there's opportunity for you here.
Yeah, and I'd say even that, and we talk about from the planning side, but it may even be a good time for a lot of people to revisit what they've done before as these have come into place. So even people who have been proactive or were proactive 2-3 years ago, it may be going back and worth revisiting. So bringing up some of that non-residential real estate, when I talk to people, it's, well, have they done a cost segregation study? Are they depreciating the components of that real estate separately, or are they just sticking with everything as a whole? That can be a sizable tax benefit that people thought they were following everything correctly, but we can put an extra cash in their pocket next year, which can then be used to reinvest or expand operations.
Yeah, I've had a lot of conversations recently around people just interested in how the tariffs are impacting business and our projections on where we should invest and what are other businesses doing to try to offset some of these additional expenses. And I think across the board, we've seen kind of a pause in capital expenses, right? It's let's wait and see. We don't want to build a new facility unless we know that we have to, or we don't want to invest in the business if we don't know what's going to happen with these tariffs. And it's interesting to think about how these depreciation mechanisms may actually increase investments in business because we know that we can take that deduction in that year, and hopefully we see some economic growth from these new enhancements. So speaking of bonus depreciation and other business opportunities here with the new act, Section 179. Taylor, you want to give us kind of an overview on Section 179 and maybe some of the changes there that we should be looking out for?
Yeah, so Section 179 is, the brother or sister of bonus depreciation. It's typically smaller ticket items, right? If you think bonus depreciation is more real estate and significant capital investments, Section 179 is smaller things. It's cars, software, computers, office furniture. So the big news is that the deduction limit has basically been doubled to 2.5 million per year, with a higher phase out beginning at 4 million for properties placed into service after December 31st, 2024. So it really benefits small and mid-sized businesses and gives them more opportunity to invest in their infrastructure and to continue to get the tools that they need to keep their business growing.
Yeah, so I think this is huge for smaller businesses. I also think about the research and development and interest deductions. Jason, you do a lot of film production, and I know you are a big fan of R&D credits, and always looking to find the best location for the films that you're producing. Do you care to give some insights around research and development and interest deductions?
Yeah, so I think there's a whole lot of pieces that move on, and I think it's worth at least commenting that everything we're looking at, it's not one or the other. So whether we're talking 179 or whether we're using bonus depreciation under 168, you can achieve a lot of the same goals through different tax code sections. And as you're looking at what's available, there may be some trade-offs on what works better in your particular situation. So as we're looking at these pieces, whether or not it's, again, bonus depreciation or we're looking at the R&D tax credits, I think we should look at it from the different angles depending on what's going on in that individual business. So for R&D, that's now going to be fully deductible in the year incurred. And this is retroactive back to the beginning of this year. So as opposed to amortizing over a 5-year period, which is what we've had to do the last couple of years, you're able to treat it in a similar way to bonus depreciation or to Section 179, and you're able to take that full write-off. So as people, again, back to that being proactive in that planning, when you choose to invest, it can be a significant difference on the taxes you're going to pay. So things like R&D that maybe you were holding off because it was that 5-year period now gives you that immediate write-off. Or if you're looking at setting up an R&D facility, what's going to classify under bonus depreciation versus Section 179 versus the R&D credit can actually shift a little bit depending on the specific requirements of that clause.
Yeah, that's that's beautiful. And you're not beautiful, pun intended, right? Because it is the big, beautiful bill. But again, I think it just goes back to how do we get proactive in our financial planning and analysis at the business owner level? And how does that impact the value of the business over this short and intermediate period of time? Again, thinking about the 9 million baby boomers that are selling their business. How do we walk through this value acceleration methodology to ensure that these business owners, when they do go to market to sell, are getting uh, the maximum amount of value for their business by taking this proactive and very thoughtful approach? So speaking of liquidity events, let's kind of transition into some of the other changes that are specific to selling a business, the estate taxes that can be represented there. One of the items that we talk about quite a bit in working with business owners is this qualified small business stock. And it's always surprising to me how many business owners don't know about this. So, Taylor, can you just give an overview of QSBS, qualified small business stock, what it means for a business owner, and who it might be applicable to?
Sure. So qualified small business stock is stock issued by a U.S. C Corp that meets strict eligibility criteria. Prior to the passing of the One Big Beautiful Bill, one of those pieces of criteria was that the business had less than 50 million in gross assets at the time shares were issued, making it a small business. And the holders of QSBS, and this is why it's so significant, were eligible for really special cap gains treatment, basically zero tax on the first 10 million when you sell QSBS stock. So historically, this has been a very powerful tool for startup investors. It's talked about in Silicon Valley all the time for founders. And the provisions of the One Big Beautiful Bill really provide several important updates for new issues of QSBS moving forward.
Yeah, so it did enhance or expand who might be eligible for this. Jason, do you have some thoughts on what those expansions look like and who might be looking at taking advantage here?
Yeah, so there was a couple of big things that kind of expanded it. First was under the QSBS, the way whether or not it determined was the asset test, which used to have a cap of 50 million, which has been raised up to 75 million. So more businesses are now eligible for this. In addition, the exclusion cap increased from 10 million to 15 million, or 10 times your basis. And that's going to be indexed for inflation moving forward. So there's more of the money that can be protected. And when it comes to startup investors or people who may be involved for a shorter term, we actually now have a tiered system. If you hold the stock for 3 years, it's 50%. For 4 years, it's 75%. And 5 years, it's the 100%. So if you're in a situation where you could get out after 4 years, you no longer need to wait for the 5. You have some option to then play with. But again, looking back to that whole planning thing, we keep coming back to it. Your decision to sell after 3 years and put money in your pocket today, or stick it out for another 2 years and get more of the exclusion, those are things we can now model. We can calculate. We can put dollars and cents and say, this is option A, this is option B. And we can have the business owners and the financial professionals make informed decisions on real data.
Yeah, I mean, that's a great point. There have been many times that we have looked at a conversion, right? Moving from an LLC or an S Corp to a C Corp. And most of the time, there's this idea of, okay, does it make sense from a tax perspective, right? If I move to a C corp, there's double taxation and all these other obstacles to overcome, and I have to hold on to it for 5 years. And I don't know that I want to be, I don't know that I want to run this business for another 5 years. It might only be three. So I think these enhancements really open up some opportunities and expand the audience for who qualified small business stock may be applicable for.
And the other thing with all of this is the idea of coordination, right? If we do make a change from an S Corp to a C Corp to take advantage of the QSBS, there's a number of other provisions that if we execute on and take advantage of, we can coordinate all of this together into a single cohesive tax strategy that's really going to serve the business owner and their family. So, and it's a really critical idea, and we keep harping on it, but the idea of planning, 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 and getting ahead of this stuff instead of just reacting.
Yeah, and I think, Taylor, with that, and I think your cohesive comment is so important because we're talking about this from the tax side, but there's also your operational side. There's your legal side. For a lot of people in that baby boomer generation, there's also your estate planning side. So again, we're looking at it from one angle here, but I think for so many of these individuals, having that all-encompassing view and looking at all of these benefits, now that we have kind of data or what's going to be in place for the next few years, really solid, well-informed decisions can be made from so many different angles. So people are not just getting the most tax benefit, but they're getting the most overall benefit from all of their hard work.
Absolutely. Yeah, that's the coordination, the proactive nature. I think that's a common theme. And what we really press on here at Farther is how do we get in front of it? And so I think about the qualified small business election and the ability to, get a big chunk of a sell tax free from cap gains. And if you're over that limit, there are other options for business owners to think about around how to defer some of those taxes, right? Many of the business owners that we work with, their biggest taxable year is the year that they sell their business. So it's how do we bring everybody on board, all hands on deck to really navigate that tax situation in the year of sale. And one of the options that we have used in the past are opportunity zones. And we've been talking for the last 2 years of, does it make sense to move into an opportunity zone? It's going to sunset. Are we really going to get the tax benefits for doing this? But there were also some changes to opportunity zones in the One Big Beautiful Bill. So Taylor, what are some of those changes around opportunity zones?
Yeah, so opportunity zones were set to sunset in 2026. With the passing of the One Big Beautiful Bill, that opportunity zone is now a permanent fixture of our tax code, with the caveat that the opportunity zones will be designated, and then after 10 years, we'll have to re-qualify basically to be an opportunity zone. If the investments and stuff are working, then, good. That means the community will be improved and somewhere else will become the new opportunity zone. But a couple things to keep in mind, right? There will be that rolling 10-year designation, and you'll get that recognition after 5 years will result in a 10% step up. There will be other areas like rural opportunity zones, which will qualify for an even higher step up in basis, a special 30% increase. And there are some stronger reporting and compliance requirements around what qualifies to be a qualified opportunity zone. So overall, the good news with the One Big Beautiful Bill is that opportunity zones are here to stay. And that means that investors can still use this as part of a strategy around liquidity events and liquidity planning and general investing to uplift other parts of the country.
Yeah, Jason, anything to add around the opportunity zones? I know you and I have talked quite a bit about this over lunches and dinners. Would love your thoughts and how not only you personally, but also some of the consulting that you're doing applies to this change.
Yeah, I think for a lot of people, and I mean, again, I'm thinking a lot of people listening on this or interested in this are coming up on a liquidity event. They're going to sell off their existing business, which is great. And they're going to hopefully get that big sale and they'll have all of these taxes to deal with. But as part of that tax planning is then what do you do with the money? I mean, you could go Scrooge McDuck and have it all in a big vault to go swimming in it, but that's not realistic for most people. It's, I had this big liquidity event. Well, now where do I put it? And as you're looking at new places to put it, things like these opportunity zones that have those step ups in basis that are going to have beneficial tax implications can help not only for the taxes on this liquidity event, but on the taxes on the next liquidity event when you're looking at exiting those follow-on investments, or again, back to that idea of estate planning as well. So what are going to be the tax implications when it's passed down to future generations?
Yeah, and that's a perfect segue to the last point that I wanted to talk with you guys about, which is the estate tax exemption. For years now, we've been expecting this to revert back to lower values, but the big beautiful bill actually stepped it up and made this more permanent. So, Taylor, thoughts around the updated estate tax exemption from the big beautiful bill?
Yeah, it's been a huge planning conversation with all of our clients, business owners, or just folks with high net worths that were potentially going to have a significant tax on their estate. So just so folks are aware, the one big beautiful bill has a permanent exclusion increase. It's 15 million per individual starting in 2025. For married couples, this means 30 million can be transferred to their heirs, estate tax free. Exemption is going to be indexed for inflation starting in 2026. So the exemption should get bigger over time. And again, it is permanent. So there is no future sunset written into the law. And it's a good opportunity, folks, or more, not necessarily an opportunity, but some relief for folks, as a lot of our clients were trying to figure out how to plan for this with the uncertainty ahead. So as we've talked about before, we now have clarity. It now gives people an opportunity to make long-term decisions and really think about what's best for them and their families.
Absolutely. Jason, anything to add there?
Well, I think that again comes back to now we have some certainty moving forward on planning, because with this sunsetting, or had been planned to sunset at the end of this year, a lot of people's tax planning had to shift, because unless they were going to get hit by a bus in the next couple of months, they were now going to be faced with a bigger tax bill starting on January 1st. Now that that's not being sunset and we can have that larger exemption moving forward, we can have more permanent planning on both the tax and the estate side.
Yeah, absolutely. Yeah, I think about this entire conversation, and the overwhelming theme is proactive planning, comprehensive advice. How do you surround yourselves with the right people to ensure that you are factoring in all of these different options when it comes to the executing on a plan? And I feel as though the majority of people, and look, we've confirmed this through research, right? Only 19% have engaged in comprehensive planning. And many times it's because they don't have the right individuals around them asking the right questions and navigating this very complex situation, right? I mean, business owners just want to go focus on their business and grow their business and take care of their employees and their family, right? So by outsourcing this and partnering with a great team that can come alongside you, identify all of the opportunities that are out there, implement and help execute on these strategies, helps raise the value of the business, helps ensure that you have accelerated the value of your business in the most level. So I really appreciate this time together. I know there's been a lot of questions around this, and how does it impact me, right? That's what I hear all the time. What does this mean for me, right? So I really appreciate your thoughts and conversation around this, and look forward to hopefully reaching out to these individuals, these business owners, and walking through this with them to ensure that they have a comprehensive plan that allows them to achieve all the goals that they have for their business, their employees, and their families. So thank you very much. I appreciate your time.
Thank you.